You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivastava Prakash.
Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. In 1966, Charles Strouse and Lee Adams composed a musical. A dialogue in that musical describes the main character, Superman, as, and I quote, faster than a speeding bullet and more powerful than a locomotive, end quote. Some people would use the same dialogue to describe recent actions by central banks. But today, we have a man here today to assure us that that isn't so. The well-known musical has its title that's used in many different ways, on which I will put a twist when introducing my guest today. It's a bird, it's a plane, it's the legendary Emil Kalinowski. Emil, please excuse my terrible attempt at trying to mimic one of your extremely amazing intros. I apologize, but thanks for being on the show and welcome to Market Champions.
Thank you very much for the introduction. It's the best introduction I've ever got. It's the only introduction I've ever got, but it's still fantastic. I love it. So I appreciate it very much. Yes, I do take too much liberty. They say it's poetic license. Well, my license should be revoked by some literary authority with my introductions to the podcast. But I try to mix it up. I try to make it sometimes serious and sometimes absurd. And the last show that I did with Jeff Snider, who I believe was a guest with you as well, we discussed 1980s television shows. And so you can count on this introduction starting out very seriously about plot, character, and setting before it descends into farce. For those that are new, that are watching the show and have no idea who I am, I promise the introduction is 2 minutes long. There's some music, and then we get to the real star of the show, Jeff Snider, and the education. So It's not the worst thing in the world.
So my first question was, could you talk a little bit about your background, your journey in finance and how you got to where you are today, and what exactly you focus on doing, especially in the minings and metals field?
I wish it was very exciting, but it's not terribly exciting. I went to a average school called Arizona State University, and I took finance because the economics degree was for smart people. And so I stuck with finance. Eventually, I found my way through different companies, like in the finance departments, doing budgeting and things like that. But I was always reading, somewhere here, I have a magazine article by The Economist, right? So I'm always reading The Economist. I'm always listening to interesting radio shows and podcasts. So I wanted to do more with my finance degree. And I don't know.
You didn't study English.
I loved English. I loved the literature. That was my favorite non-core courses that I was taking in college. And then outside of school, I was reading as much as I could, to which my mom would complain, you read too much, which is not bad. Everyone in my generation was being beat up and doing drugs and things like that. So I thought it wasn't too bad to do, reading. And anyways, I eventually found my way to the Cayman Islands, and what happened? I fell into a metals and mining industry company where my job is to research what's not only happening with the metals that we're investing in, but the context of those metals. For example, copper and nickel, a few years ago were just copper and nickel, but now they're being seen as green metals, right? Because they can power the green revolution. So my job is to research that context, and that's why I love talking about monetary matters, because we happen to be in a moment in our collective global history where the monetary order as it exists is unstable, it's shaking, it's been like this before. And in those points in time, precious metals played an important role and the monetary order changed. So that's kind of my job, is to research, write, read, and that's it.
And sort of your profile picture on Twitter it's a gold coin. So are you sort of like a secret gold bug, a secret inflationist?
I'm no, not secret gold bug. I'm out of the closet, and I might as well come out right now here live on your show that yes, I am pro gold. I think anybody owning gold would be a wise investment at this kind of moment in history. There are other periods in time when everything is functioning rather well and the existing social order is in good shape. You are a young man. I'm also a young man, but maybe not as young as you. No, I'm trying to make a joke. I'm an old man. But you're a young man, but you've interviewed lots of people, and they tell you this is unusual, what we're going through since 2007. It's unusual, it's unnatural. There are moments when it won't be like this, and therefore owning gold in those times, not critical. But during these particular times, it's important, I think. So yes, I do recommend gold because I feel we are in a kind of a disinflationary decade that we just passed.
Right.
But maybe the corona changed some things, and maybe we'll be switching over to an inflationary future. I think eventually we'll be, anyhow. But maybe 2020 marked the end of the beginning and the beginning of the end.
Now, I wanted to take something that you just said, which was sort of a changing social order. So now, could you go into what you mean by that? I'd like to remind you that stock markets are at all-time highs. So, the social order right now is it's pretty good. So could you explain, what that means?
Well, are you a Game of Thrones fan by any chance?
No, but I'm guessing some of our listeners may be. So go ahead.
How about, did you ever read Isaac Asimov's The Foundation series?
No.
No problem. Have you ever come across, this is my last one, I promise, The Gods of the Copybook Headings? It's a poem by Kipling.
No. I've read other Kipling poems, but not this one.
What all three of those have in common is that they're about social orders coming to an end and a new one coming in. It's perfectly natural, except that we as humans, we don't think that history happens to us. It usually happens to other people, usually in the past. But every few generations, there's a new social order, a new economic order that comes into force, because the one that was established before was established so long ago. Nobody really knows why we should still stick to it, why we should still follow those rules. And the last one that was implemented around the world was after the Second World War. And that generation has passed, and now there's nobody around anymore saying, well, why are we still following these rules? These rules don't make sense for today's age. And so people want to leave this order. The institutions that were established 4 generations ago aren't functioning well anymore. Things are breaking, but we can't seem to find our way to a new order. No one is there that's proposing a new system, a new social contract between government, the wealthy, the average household, and businesses. We don't hear those proposals, and therefore we've been struggling. But the point is, from those novels and the poem I mentioned, it's supposed to take quite a long time. The fourth turning, I don't know if any of your guests have discussed it, but the fourth turning estimates that it takes
80
one
years.
generation. A recent American author, George Friedman, he's very well thought of in the geopolitical field. And he just wrote a book called The Storm Before the Calm. And he also talks about that idea that it's going to take the rest of this decade to transition to a new social contract. So yes, stock markets are at all-time highs, but dissatisfaction, wealth inequality, unhappiness, fertility rates, deaths of despair, economic growth per capita, These are all terrible at ugly, ugly levels. And the longer it continues, the angrier people will be, not just in North America, but we see it in South America, we see it in Europe. So it's a global situation. At least that's my perspective. But what about you? Have you seen that? Is that what you sense in Toronto, in Canada?
Well, I wouldn't go so far as saying the entire social order is about to change, but again, I haven't read the books that you've read, and I've not read the book by Asimov or the poem by Kipling. So I think it's better I take a look at those. And I want to bring the spotlight back to you and ask.
On to you, please. I'm very impressed by your show, what you've accomplished. That's fantastic.
Thank
As
you.
no doubt many of your guests have told you,
Thank you.
they weren't doing anything when they were 16. So we can't wait to see where you're going to be in a few years. You're going to be a media sensation. It'll be fantastic.
Thank you.
Congratulations. Keep it up. I can't wait to watch over the years how you progress. So, and I'll be very, very happy to be able to tell people, yeah, I was on the show. That was episode 139, 140.
140, yeah.
Yes.
Thank you. So, going back to our discussion on the social order, do you have any predictions on, or do you have any thoughts on, how it's going to play out? Because if you sort of, ask a normal person, who's paying attention to the news, the one thing that they will notice is sort of either, people are moving more and more to the left in terms of politics and economics. So, sort of the rise of democratic socialists or social democrats, as you like to call them, and or there's people moving more to the extreme, and moving further and further right, and you see the rise of sort of far right conservatives, that kind of thing. So do you have any predictions on how this is going to play out? Are we going to see a civil war? I know you have already made me scared, so it's better I ask these questions.
Well, you should definitely not be listening to me, what I'm saying. I'm reacting to what I've learned from others who have thought deeply about these issues. And Neil Howe, who co-authored The Fourth Turning with William Strauss, he raises the possibility of civil war in the United States. And so when you say civil war in the United States, people say, that's absurd, it's ridiculous. But a measured, calm individual with a long-term historical perspective raises that possibility as remote, but plausible under certain circumstances, at least in this kind of moment when the institutions aren't functioning, aren't responding. But we're a long way away from that. But what do I predict will happen? I predict that things will continue to get worse. The established politicians will continue to offer tinkering, tweaks to the existing order, as opposed to proposing an entirely new social contract. And so it'll continue to get worse until somebody comes to the fore that offers a vision. And unfortunately, sometimes that comes with comes in two pieces, like a vision. This is what we're going to achieve, and we're not being able to achieve it because of those people. So that's pretty often how that happens, unfortunately. But it doesn't have to be that way. But the key to get everyone unified once again is to create a crisis, not create, to experience a crisis as a society, a searing hot crisis in which all the individual pieces are melted together into one cohesive soul whole that survives, conquers, and emerges unified. It sounds crazy, and yet that's what we see repeatedly across Anglo-American history. So that's sort of what I'm seeing. Right or left, I don't know. Both, depending on which country you're in, which region. Both will be trying to offer solutions. Hopefully one can kind of melt the two together, offer
Right.
some sort of perspective from this and that party. We shall see.
Got it. So I wanted to move towards with some of your thoughts on metals as a whole. So, you and Jeff Snider, you've sort of worked on this overall disinflationary or deflationary thesis. The economy as a whole is not improving. And, sort of the core point is that the central banks, regardless of all the money print or go brr memes that we see, they're not actually printing money. And so could you talk a little bit about how this affects, the thesis that you're working on with Jeff, how this sort of affects the mining industry, both during and after it plays out? Because I'm specifically interested in your views on copper and silver, because they've got their individual uses. I think you also mentioned that copper has its use, especially in in sort of green energy, and silver has a lot of industrial uses as well. So I'd like you to talk about that.
Sure. Well, Jeff Snider, who's my partner on a podcast and television or YouTube show that we do called Making Sense.
Yeah.
It's a
Wait, did I forget that in the introduction?
Excuse me?
Did I forget?
Did I?
No, I think I forgot that. I'm sorry.
That's okay. Your introduction was better than the professional ones I go to, where they say,
yours are the best, though.
That's all right. So it's Making Sense, a Eurodollar University production with Jeff Snider, and I'm on the show too. And Jeff has really worked hard in trying to understand how central banking works, so hard that he reads all the transcripts, all the speeches for years, from decades ago. And he has a real sense of how well the system works. And basically, essentially, is that the central banks are central in name only. They don't actually create the money that makes the world go around. And the money that makes the world go around is credit extended by the private bank. The central bank creates a kind of money. It's a money, much like a nickel or a quarter. That's a money. It's not as super exciting or useful or flexible as a credit card, though. That's also money. And so they hope by creating this thing called bank reserves, which is only really useful for banks. And by flushing the banks with bank reserves, not all of them, as we talked about in our last show, the bank reserves are siloed in the biggest banks, right, but they're not spread well enough across the whole system. Even though the system seems to have a huge amount of bank reserves, it's only in specific banks. Even those banks they're looking around since 2007, and they say, we don't like the way this economy looks. We don't want to extend credit to the global economy. And even though credit is rising, if you look back through time, back to the 70s or even before, you would see that money was growing at this kind of a rate. And then ever since then, it's been positive, but very meek, right, very meek. And therefore, global economy has been struggling because banks don't want to extend their balance sheets. Here's the best example. Before 2007, banks wanted to grow their balance sheets, to become bigger, acquire other banks. That was the name of the game. After 2007, most European and North American banks, I'm thinking of the American ones though, specifically, shrank or grew much, much more slowly. Last year, I remember in January, the UBS CEO admonished the European banks for trying to, quote, shrink to greatness. So if banks are shrinking, we have less money as a society, as a global economy to function. And the central banks, despite all their efforts over the last 13 years, have only been creating this sort of inert money, as Jeff and I often refer to it, a kind of like a laundromat token. That's money. It's money. It's useful, right, to specific people in a specific area. If I give you 1 billion laundromat tokens, you would work hard to convert that into economic dollars and, right, money. But the banks, they're like, we're going to keep the laundromat tokens because it's too risky out there. So anyhow, that's what the central banks do. And therefore, for the metals and mining industry, it's been a tough go of it since 2011. It's been more disinflationary and deflationary because there's not as much credit going out into the world, not as much money supply as before, and therefore the prices have been generally falling since 2011-12. More recently, they've started to come back up. And well, we could talk about this, but I'm going to answer your copper and silver questions. But I think that might be different, because what might have been new in 2020 was that banks got back in the money creation game because governments told them to. Politicians, not central banks, politicians seeking re-election guaranteed the government guaranteed loans that private banks made, bank loan schemes. And this may be something new. This may have potential if the politicians realize, wow, I can send money to people who will vote for me, and without raising the national debt, because the debt will be off balance sheet. It'll be a contingent liability. It won't be on my balance sheet. It won't be on Canada's balance sheet. It'll be on Toronto Dominion's balance sheet, because they will be extending the loans and we will be guaranteeing them. So far, they're feeling their way around it. We'll see if they take off with this. I can go now to copper and silver, but anything I said there that you wanted to go on talk about, or no?
We'll get to that in sort of like the next segment. So you can go on.
I didn't want to dominate and talk. Gold, no, not gold and silver, copper and silver. So copper, it has electric. It's primarily an electric metal, right? That's so much of it goes into electricity, but also construction in China is very important there. But it's this electrical conductivity of copper that makes it so appealing to the Green Revolution. Now, copper is a gigantic market, gigantic.
Right.
And so the Green Revolution is only starting to grow in this gigantic pool. And so it'll be a little bit of time before copper is really feeling the effects of the Green Revolution. Cobalt, for example, much smaller market, that's feeling the effect of the Green Revolution immediately, right away. Silver, big market, about 10% of silver goes towards photovoltaic cells, which is a fancy word for solar panels. But it's also being used in a little bit of nuclear power, and oh goodness, I forgot another one. Electric vehicles, in actual vehicles, it's starting to grow. So if the automobile industry takes off and it's very focused on electrification, we'll see more silver there. But nickel is another one that's very important. The batteries that so many of our cars, electric cars, will likely be using are heavily based on nickel. And nickel is a much smaller market than copper or silver in terms of the proportion that will be required soon from the Green Revolution. So copper, sure, silver, yeah. Cobalt and nickel, even sooner. Smaller markets, bigger impact whenever the Green Revolution comes. A few years, I suppose.
Got it. And I wanted to stick with copper for a minute. A lot of people depend on what they call Dr. Copper to sort of tell the state of the economy. And if you see what happened to copper since March, it's gone up, it's gone up quite a lot. I was looking at a chart yesterday, went from somewhere in the 2s to I think it's 350s right now. So, that's a pretty big increase. So I wanted to ask you, a metals expert, what's going on, especially, with your knowledge of what's going on in the monetary system, that the things aren't all right. There is no reflation. The economy is not actually getting better. So would you talk about what's actually going on in copper? What's caused
the economy is getting better, but not super fantastic better that perhaps would what would the word be? Back up or
vindicate,
confirm. Like, what was it? I'm sorry?
Vindicate.
Yes, exactly. So copper, I would say copper's price has gotten ahead of itself. Things are better than last year. There seems to be a reflation. China, the biggest copper user in the world, did focus their economic recovery on fixed asset investment versus on the consumer side. Most of the world supported its consumers. China supported its real estate sector and fixed asset, in infrastructure projects. So that helped copper. Copper was also helped along because the Chinese State Bureau bought a lot of copper. They don't tell me anymore how much copper they buy. They say it's a state secret. Okay. So honestly, it is a state secret, so no one really knows. But industry analysts have estimated, they've put some guesstimates around it, and it seems pretty substantial when you look at it from a bottom-up basis. So when you count all the widgets, all the pipes, all the electrical wire demand in China, you count it all up, and then you count how much copper actually went in. There's a big discrepancy, they say. And so unusually large amount of copper in any one particular year was probably set aside by the Chinese, kind of like the United States has this oil reserve where they set barrels aside for a rainy day one day. So I would say copper is reacting appropriately to improvements in the economy, but there's also the fact that it's perhaps more focused on China. Also, that Chinese government was providing non-economic demand that likely won't be here this year, very likely won't be here this year. And therefore, I would say seemingly a little bit ahead of itself, but I'm no good at timing copper prices or any other kind of prices. That's just my general sense of it. That's what I would say.
Got it. So I wanted to now move to more of sort of the monetary side of things and ask you some questions on the monetary system. So I wanted to start off by asking you, if you had to try, do you think you could make the case the mainstream, the mainstream guys on Twitter, the mainstream, fund managers make, all this QE goes into stocks, commodities, and other assets, and sort of articulate the process step by step, is there any way that you could talk about how QE actually ends up, boosting asset prices at all?
I think it's mostly sentiment that the central bank will be there to backstop the financial system, that the institutions are too big to fail, and therefore where they lend, the hedge funds, the speculators, that they will be supported. What else would I say? I wouldn't say that there's some sort of direct link where bank reserves are being taken, translated into dollars, and then used in stock market speculation. I would say it's more sentimental, more sentiment driven, but I would also say that the banks are given these bank reserves, therefore they have the liquidity they need, and then it's a risk return proposition.
Right.
And where should they invest? Should they invest in the real economy where demand is uncertain, wages are not growing too well, therefore end consumption will likely be questionable, where consumers are generally paying down their debts, reducing credit? So that's not really what would you would know? What's the word? Encouraging environment, and not an encouraging backdrop. And would I suggest also that social contract is missing? I believe that people sense that it's not clear what the rules of the road will be tomorrow.
Right.
The rules may change rapidly.
Absolutely.
What if someone very conservative or someone very liberal came into power? Maybe very strong government intervention will be the order of the day. And therefore, making long-term economic investment seems risky if you don't know what the rules of the road are, if you feel there may be a social change soon, and then plus the end demand is not there. The per capita GDP growth rates for around the world are dreadful. So you have a lot of reserves, you have this liquidity, maybe putting it into the stock market would make more sense. I suppose you can see that with the decisions that businesses themselves make by buying back their own shares instead of investing heavily in infrastructure and fixed assets. I think that's the sense that we've been seeing. So I would say that's the reason that we're seeing these stock markets rally, is that people are putting money into where they can make money, not necessarily for economic purposes.
And to talk about what you just said about how it's too risky to lend out there. Now there, I believe in big debt crises. Ray Dalio has talked about how credit actually makes things better, and an extension of credit makes things better. This making things better leads to another extension of credit in a reflexive loop. And George Soros has talked about this in his incredible book, The Alchemy of Finance, as well. So, do you have any thoughts on that? Do you agree with that view? Because usually, what their stance is that a bank sort of, if say someone lends credit, the person who borrowed money is probably going to go spend that money, and one man's spending is another man's income. So, someone else is going to earn that spent money, and when incomes go up, asset values go up because the price of assets is calculated based off the income that it's able to produce. So and when asset values go up, it's these assets that are used as collateral for lending. So when asset values go up, the collateral value is going up, and when this collateral value goes up, that leads to a further extension of credit, and the cycle sort of starts off once again. So a lot of so from what I understand, it usually just takes sort of one I guess sort of one kick to get it started, and this process can start continuing. But I wanted to hear your thoughts on what I just said.
I think it just depends on the era and the country and the system. In certain times, that makes sense. In others, it
Not
won't
so much.
work. And I think it's during those moments when you know what the long-term lay of the land is, where these sort of credit, beautiful, beautiful cycles. What was it, the phrase that he used?
Beautiful deal leveragings, but I think that was sort of to describe
Mm,
something
well,
else.
very well, very well.
I think Soros called it a reflexive loop, so let's just go with that.
So these uh, these bull runs are good and they're helpful and they create advancements in technology. Perhaps they set off globalization, a relinking of the cultures, transportation, communication, wonderful things, wonderful things. They get too far and then it resets backwards and we start over again. The question is, every once in a while, though, it seems to build up, and that seems to be what Minsky was writing about, is that, yes, we have these cycles, and they're healthy, but they seem to build on each other until you get to some sort of large systemic reset. So I think we have gone through our normal sort of cyclical recessions, and now we've reached that point where we're at the systemic reset, where we're stuck and we're not able to create the credit that we want to, that would be healthy, that would be useful. So the funding the new technologies. I read a book by Richard Vague recently. It was called A Brief History of Doom. It was great, short, snappy, very educational. And it talked about how the credit was directed to real estate and industries and railroads and communication, but it would go too far. There would be a crash. And then you would just have to start over, I suppose. So I guess it just depends. Sometimes it's good and sometimes it's bad. And we're just humans here on Earth, and we're going to have to do the best we can to survive these things.
Got it. I wanted to ask you, working with Jeff Snider, have you built your own indicators to indicate liquidity conditions, or to indicate what's going to happen next, or anything like that at all?
Well, Jeff is great at that, and he writes about it all the time at Alhambra Partners. So he lists a lot of them very frequently. I wish I had one.
You print them?
Okay, I'm back. We could have gone to commercial there. Okay, so yeah, he lists a number of them. Bond yields, inflation expectations, short-term rate expectations in Eurodollar futures, repo rates, swap spreads, positions of dealers with collateral. How much collateral are they holding on their books? The US dollar, trade exports. There's also several lines in banks, central bank balance sheets where they talk about how much do foreign institutions, official institutions, hold of US Treasury securities? How much are they asking for from the Federal Reserve? So these are great liquidity measures that tell us what kind of condition the monetary system might be in. But as Jeff often mentions, this is very difficult stuff because it's all in the shadows. It grew up, it came to being outside because of extreme regulation. After the Second World War, the debts were at extreme levels, and the countries of the world decided we need to implement a policy of financial repression whereby we will inflate away our debts slowly. And therefore, that means we need to keep a real tight leash on the banking system, on international finance, so that we can keep savings here, because savings would say, I'm not staying around, I'm not paying for your debts, get out of here. So they had to keep the savings here, regulations, restrictions, taxes, capital controls, and then they would slowly inflate away, keep inflation rates above the rates of return.
Right.
In the United States, there was something famous called Regulation Q, which would cap where interest rates could be paid on deposits at banks, and then inflation was kept here. That's just an example. Anyhow, after the Second World War, financial repression kept money in a pool. Inflation whittled it away, but banks in Britain, presumably, because we don't quite know, they said, this stinks. All right, it's 10 years now after the war, and we are still having to pay for this. Why don't we work outside the system? And so they started doing some things outside of the regulated system. And then it came to the attention of the authorities, and the authorities had a decision to make. In Europe, the authorities said, no, we're not going to allow this. But in Britain, they said, you know what? We will allow it, but your dealings have to be with non-British citizens. It has to be outward facing. But it'll be a light regulation. Know what you're doing. We're not coming to your rescue. And so this Eurodollar international financing system grew outside of regulation, in the shadows, offshore, Gibraltar, the Cayman Islands, the city of London, where else? Liechtenstein, Luxembourg, Hong Kong, Singapore, outside of the main regulated institutions, dealing with outside customers. And so it was so hard to regulate, keep track of. And then the authorities in charge, it seemed like they weren't interested in actually looking into it very closely. And so this system exists outside of the authority of the central banks. And therefore, it's very hard to measure what is happening. A bank extends a loan to another bank. It's over the counter. You and I are not privileged. They don't tell us about it. Did they call you up? Did they tell you what they're doing?
No.
They didn't call me. They didn't call me. They didn't call the regulator. We don't know. It's all intra-quarter. Maybe at the end of the quarter, at the end of the month, they have to report what they're doing, maybe.
Yeah.
And then by then it's kind of cleaned up as to what's going on. So we have to sort of look at these measures, not directly measuring the system, but its effects on things that we can measure, like bond yields, inflation expectation, the Eurodollar futures, how much foreign central banks are borrowing dollars from the Federal Reserve, that sort of thing.
Yeah, this would make like a really, really good novel. I think you should write it.
The good news is I already have a title for it. Tell me if you've heard this one before. Making Economics Erotic Again. Yes, erogenous. Yes.
Yes. Someone was asking, when those hats are coming out with making economics erogenous again.
They are being produced right now by Eurodollar Enterprises. They're working hard on it. We have several product lines in the works. We have the Clench 5000. We have the premium quality bathrobes. We have the second neck brace. And recently, I can't say this, but it's an illicit drug, but it's organic. And so it'll be on the website soon enough.
Got it.
All for economics.
Anything for economics.
I got to make economics fun in some way. Jeff knows it ins and out. He's very serious, very knowledgeable. I try to be a little bit absurd, a little bit of silliness, and
Yeah,
and
I think you do a really good job at that. Making economics as a whole fun. Making the conversation for Jeff fun. Because I don't know how many people would be interested in listening to someone talk about these obscure transactions that go on offshore, but you make it really interesting and really exciting. So yeah.
well, thank you. That's very kind. That's very kind.
So I also wanted to ask you, you follow sort of the works of, people like Brent Johnson, Jeff Snider, Steve Van Meter, these guys are sort of, they're in the
All
deflation.
scoundrels.
Yeah. So yeah, they're sort of in the deflationary camp, but then you also have people like, say, Luke Groman, Russell Napier, who are on the inflationary camp. So do you have, what's sort of your,
Gentlemen, each and every one of them, gentlemen.
so what's sort of your overall thesis? Do you think that one day the US dollar will be thrown off the banking system thanks to government-backed lending inflation and, government-backed lending like we saw in 2020, and then, inflation will finally run hot?
Yeah, that's always been my outlook, is that we're a disinflationary, deflationary, Brent Johnson, Jeff Snider, Van Meter outlook. We're in a depression. I believe it. I call it the silent depression. I say it's the third worldwide depression of the last 150 years. It began in 2007, and we're stuck in it. And there's no economic solution. There is no monetary solution. I believe the only solution is political, and that's where Mr. Groman and Mr. Napier come in. It's a political solution that will come one day. I don't know when. Again, fourth turning, winter is coming,
Right.
a Harry Seldon crisis, the gods of the copybook headings. One day we'll have a political resolution, and that political resolution is most likely going to be an inflationary one, because it is the least worst option. The other options are default on all the public and private debts. That would be very difficult on the economy, very disruptive, and it would be an impediment to the re-election of our politicians who would be implementing these policies. We can't have that. Number two, we could hyperinflate away, and the republics of Weimar, Venezuela, and Zimbabwe gave it a bad name. But as I learned from Mr. Napier, France, after the Second World War, did an excellent, sophisticated job of inflating away their debts very quickly in 5 years. But again, it's a high-risk political decision, which may put some politicians out of work, likely. And that, I don't see a lot of courage from the politicians I'm aware of. I know all the Canadian politicians are courageous, so I'm not saying anything there, but everywhere else. Therefore, option number three, financial repression, the slow inflation away of our debts, seems to be the most likely policy. There are two other policies: growth. We're in a depression. We have been for 13 years. That's the Van Meter, Snider, and
Could you actually could you explain why, or like how we've been in depression? Because, if you take sort of, if you sit down and look at sort of most of the economic numbers have been pretty good. We saw the greatest bull market ever. Um, we saw sort of unemployment go all the way down to the threes. We saw inflation was a low and stable. So could you talk about how exactly, since 2007, we've actually been in a depression?
Absolutely. Great question. The difference between a recession and depression is that a recession includes, as part of the package, it's a 2-for-1 deal, the downturn and the upturn, the shock and the recovery. That's a recession. A depression is just the down, but then the recovery is never really a recovery. You never get back to your pre-recession trend. You just have a reflation. You have positive numbers. And what a lot of people don't realize is that human society comes with positive numbers baked into it. Like when we look at, for example, transistor chips, right? It's Moore's law. It's supposed to be expanding. You might know it better than I do. I think it's every 1.5 years
I
or
don't know.
2.
I don't know.
It's supposed to
I'm sorry.
double.
Yeah.
No, it's the number of transistors
Yeah.
on a microchip is supposed to double every few years or every 1.5 years. Same thing if you look at flight distance records. How long can you go on a single flight without powering up? All manner of human achievements are non-linear, including economic growth.
Right.
I'm sorry?
I said right. Yeah.
Yeah, so even if you have positive numbers, we've had positive growth since 2007, but it's been much, much less than the growth we had experienced with all the recessions since the Second World War. And that's what we're missing, because there's no upside. There's no belief that we're going to escape this, because we keep having a crisis every few years. 2007, 2009, then in Europe, 2011, 2012, then across the emerging markets, 2014 through 2016 early, and then 2018 through 2020, we had another slowdown. So the depression, this is something James Rickards brings up often enough, is the lack of upside, the lack of hope, the lack of boom, the lack of acceleration, the surge that would come. That doesn't mean all the numbers are terrible. You can have stock markets that are up. I took a look at the long depression that took place in the 19th century and the Great Depression in the 20th century, and I saw that the US stock market rose during both depressions. We're seeing that again now. It's rising more than back then. So you can see it. As for the unemployment rate, I would say that's a function of the missing labor force, at least in the United States. In other countries, I don't know if that is the case. You have a labor force that has shrunk. Therefore, the unemployment rate is misleading. And I believe that's it. If I didn't answer something, let me know.
But usually, when people think of depressions, they usually think of, say, the Great Depression, along lines with soup kitchens. And, we see, uh, we see tons of people out of work. But
We have lots of people out of work. We have lots of people that are not hungry because they
I
are
was talking like pre-COVID. So like from 2007 to 2019, most people would argue that, it was pretty normal. They had a job. They were able to, so keep food on the table for the most part. They were able to make their mortgage payments. They were able to take a vacation every year, every 2 years. So.
Well, I would say that if you take a look at kind of large scale, like a per capita GDP number, you would see that growth has been there,
Right.
but it's been on track with what we saw in previous depressions around the world. So yeah, I'm not saying
There's no
lines,
growth, but
although
you're
we
just saying
have.
they're saying like, you're not saying there's no growth. You're just saying, it's a lot slower than what it's supposed to be or what it usually is.
That's right. We're in the doldrums. If you go sailing and you're near the equator, you can get stuck in the doldrums where it's just listless. There's no wind and you're just floating, going nowhere. You're still alive. I guess you're making progress, but it's miserable.
Got it. So I wanted to ask you, what exactly are bank reserves? What are these things? You got, in Making Sense Zero Dollar University, you talk about how the Federal Reserve increases bank reserves. So what are bank reserves? And, can bank reserves be exchanged for like actual cash? Can, someone, wouldn't that just be, wouldn't that just be sort of going to the Fed and saying, I'm selling these bank reserves and, I want cash for it instead. So.
I like to think of them as a kind of a regulatory money. So their money has different purposes and for buying things, but for banks, this bank reserves allow them to make their balance sheet more flexible, to extend loans into the private economy. If they have enough bank reserves, then the Federal Reserve says, or any central bank will say, you're in good shape, you're healthy. If there was ever a run, if your assets were ever impaired, if something went wrong, you have enough of these reserves, which represent what would they represent? They represent your ability to come to us to help you.
Right.
And so if you have enough of them, then you're allowed to take more risk. So it's a kind of a money that's useful in trading, dealing with other banks, in buying some government debt, if sometimes if the government wants you to, if they'll take your bank reserves sometimes, but I wouldn't think they would take just bank reserves, because they too have to turn that around and then distribute it into the economy. And the real economy doesn't use bank reserves for anything. So it's a regulatory relief, freedom.
Mm-hmm.
And the banks have a reasonable amount of it, but the risk out there is too great for them to really go in face first, no pants, into the pool, yelling cannonball. No, they don't want to do it.
And the reserve requirement is at 0%. So basically the addition of reserves technically makes no sense other than the way it's used in expectation policy, which is what you guys talk about in your podcast. And one view that I've seen is that Warren Mosler, who was sort of the MMT guy, one of the biggest proponents of MMT. He wrote a book called I think it's Soft Currency Economics 2 or something like that. In that book, he mentions that banks usually lend first, and then they borrow the reserves later, as and when it's needed for accounting purposes. So, do you agree with that view? And what are your thoughts on that?
I saw an interview with Mr. Mosler. Is that right? Did I say his name right?
Yeah.
And I thought I generally agreed with it. I didn't have a problem with what he was saying. I think there's a big hang up with the idea that banks can create things out of thin air, or that the government can create things out of thin air. And it's very hard to believe. It seems outrageous. And if I remember correctly, there's a beautiful quote by John Kenneth Galbraith, where he says that something so profound as money should have some deep, dark mystery behind it. Just make it up. They write it with a pen and they balance the ledger and it works. And the government does that. And that's what Mr. Mosler's point was. And so I don't disagree with that general thesis. The only part I had a real hard time understanding, and I haven't quite got an answer to it from the modern monetary people, is this very strong insistence that the government creates money.
So money is a public monopoly. That's
perfect.
Yeah.
Thank you so much. That they have a monopoly on currency. And Miss Kelton is very specific in her book to always use currency when she says that. And I agree. They have a monopoly on currency, but our world doesn't run on currency. It runs on money, which private banks make up willy-nilly. And so I have a difficulty reconciling why they're so focused on this monopoly of the currency and kind of not saying anything about the private banking system. Have you heard anything? Have you heard any kind of, or is that not even relevant, that kind of my confusion there?
I don't know. Usually, from what I see, is that modern monetary theorists, they tend to say that regardless of what regardless of what the private banks are doing, the government can still create cash. They could just print it and they could spend it. So regardless of what, at least that's what I've read. So regardless of what these private banks do, the government can still print this cash and still use it in the economy. And if there's inflation, the modern monetary theory, their solution is to tax it. And if we tax, we get money out of the system. But I think sort of the problem with that is, especially if you are sort of a capitalist libertarian. I don't know about you, but that's sort of where I stand personally. And what they usually say is that taxation will sort of stop resources from getting allocated by the free market, instead sort of shift the resource allocation decision to the government, and overall that shift would be a bad thing in the long run. So
yeah, I'm with you, and that's my kind of preference as well, is more laissez-faire sort of management of the economy, but that doesn't work in all eras, unfortunately. That's what I recently learned. It seems like we're moving away from that. Another point, so, okay, so you tax the inflation. I agree, that makes sense, but governments are not run by angels or
Right.
technocrats. And the problem is it's going to be a politician who's in charge. And what politician have you heard recently that says, I'm going to start taxing, I'm going to start raising taxes because this inflation, this economy is running too hot? That doesn't happen. They're not going to raise taxes, or it's going to be really hard. It's not a simple, hey, inflation, we're going to tax. That's what a central bank would do. They have that technical ability, right? The lever pulling.
Yeah.
But if you give the power to the government, that's okay. Politicians are going to love that sweet nectar that comes from the magic money tree, and they're going to get drunk, they're going to get addicted, and then we expect them to step in and say, party's over. No. Well, after their reelection, maybe. Then they'll say it.
Right,
So
exactly.
I
Now
think
that,
that's the problem. So I think the modern monetary theory people, I get it. And I think it really comes down to where you are politically. Do you believe government is kind of self-regulating, kind of the liberal perspective, or maybe you're more conservative and you don't want to give the power to the government because
right.
it'll be corrupting. So I think that's where we eventually get to.
Got it. Yeah, I agree with you. I agree with what you just said. And
Yes.
so I know we might be running out of time, but I have two more questions if you're okay with that.
My time is worthless. So however long you want to stay.
Yeah. Yeah, sure. So I wanted to ask you, how useful is the Fed funds rate in in causing inflation? So one of the sort of the Federal Reserve's magical lever right now is the Fed funds rate, and they're sort of at least thinking that it's going to control everything. One of the things that I realized after watching you and Jeff Snider was that there's this famous autobiography by I don't know the author, but it's The Man Who Knew: The Life and Times of Alan Greenspan. But I think
Yeah.
I think the title should be changed to The Man Who Didn't Know.
Yes.
Yes.
I didn't read it, but I heard Sebastian Mallaby. I will bet you one silver coin that Sebastian Mallaby wrote that. I hope that's right. What are silver prices at right now? Oh my God, have I overextended myself?
The Man Who Knew Life. Hold on. Let me find this.
Well, I
Yes,
heard
it is Sebastian Malvi. You got it right. However, I did not bet a silver coin, so I will not
someone
be.
owes me a silver coin. Well, I heard great things about this book. But go ahead. So yes, so tell me the book Greenspan Federal Funds.
Yeah, so Greenspan sort of used the federal funds to control sort of everything from LIBOR to how much banks in the U.S. lend, um, sort of the central interest rate. And Jeff Snider points out that in the 1990s, actually, the central banks, and Alan Greenspan admitted this, they sort of lost track of what money is, and so that's why they shifted from, say, money supply or money demand targeting to Fed funds targeting. And so I wanted to ask you, how useful is the Fed funds rate in actually causing inflation?
Well, Mr. Snyder would say not at all, that it was destroyed in 2008. The market for federal funds was destroyed thereafter because that was an unsecured lending pool. And therefore, if we are in a period of globalization, if the economy is growing, if the world is one of only return and a little risk, but mostly return, and you have confidence in your central banker, you will lend unsecured to Bear Stearns, Merrill Lynch, Lehman Brothers,
Absolutely.
American International, because you have confidence.
Yeah.
Everyone, there's no problem. After 2008, no. And people realize, whoa, we are not lending unsecured again for a while until we have confidence that all this is working again. And there's no confidence of that. And therefore, the federal funds rate, whereas before it was lively and energetic and something useful, is now just a shell and a husk of its former self because the banks dare not lend in scale unsecured because you don't know what is going on. So how is it, and is it going to cause inflation or control inflation? Well, that was the theory. And Jeff says no. What happened was that there was a rising tide of liquidity being created by private banks and that was given the name of the Great Moderation, because things were going so well. It seemed like moving this rate around had an impact, but upon reflection, no. And I guess he makes a wonderful point that it's insane because the financial system is so crazy complex. And you're telling me 12 people sitting in a boardroom somewhere moving a rate down or up by a quarter of a percent is going to move the markets? He says that's bananas. And so, but I think perhaps the most important point, what you just said for our audience, if anyone is still listening to me here, going on and on, the Federal Reserve in the 1990s admitted they couldn't define, identify, measure, or map money. Not an exaggeration. They didn't know what money had become. It had multiplied like a prism. It used to be something. It went through the prism of the private banking system that was searching for ways to make money. They're banks. They want to make money. And they created this amazing rainbow of monetary equivalents. And the Federal Reserve, they said, we don't know. We don't know what money is anymore. And it is our hope that we can affect how they behave by raising this rate up and down. And it turned out to not be the case that they were able to do that.
Got it. And as you talk about the Fed funds rate and how it doesn't really control bank lending, so I wanted to ask you, now is sort of the interest. So I believe the Bank of England in the UK, they target the interest that's paid on excess reserves, so the IOER. And I wanted to ask you, if the IOER is moved negative enough, would that be something that could force banks to lend? And because sort of the opportunity cost of lending is holding these reserves, and if you can make the argument that the IOER is way too high, especially in the US, if you brought that all the way down to say somewhere in the negative, say 50, 100 basis points, and you just kept bringing it more and more into the negative, do you think, sort of banks would finally be forced to lend? Or do you think, sort of treasury demand will start going down? But that's not possible with what's going on in the repo market. So do you get what I'm saying?
Yes. Can you make it negative enough to make people lend? I would say generally no, because it would signal that there's something seriously disturbed and wrong with the economy or the people in charge, because negative interest rates, according to Mr. Grant, who interviewed Mr. Silla, who wrote the interest rates for the last 5,000 years of history, he said that
Was that is that Jim Grant, the Grant Rate Observer guy?
Yes.
Okay.
He often says that negative interest rates nominal interest rates are a first in 5,000 years of human financial history. And so it signifies great disorder, sickness, and making it more sick, more disturbed, more Alice in Wonderland, I think would tell banks there's something really wrong out there, and they'd rather just lose the 1% or whatever it is than lend out into the economy, which is so unhealthy. So I think that would be more of a philosophical than a technical explanation. Mr. Jeff Snider and Mr. Stephen Van Meter would be able to provide the actual technical explanation of what they would do. Mine is more of a philosophical answer.
Got it. So I wanted to ask you, to wrap up the podcast, any last thoughts on what's going to happen? Any last thoughts that you want to tell people?
Oh, I want to tell people that there is a glorious, beautiful, golden future and golden age ahead of us as soon as we get out of these terrible, ugly times. Because, as those authors I mentioned in the beginning, the stories, the real ones, fiction and nonfiction, if we get out of this successfully, we're going to be united. We're going to believe that we can accomplish anything because we just did. And there will be a new set of rules for the road ahead. People won't agree. I mean, they will, well, people will be upset that there will be new rules. Well, it wasn't like this before, but there will be rules of how we're going to govern our society, a new social contract. And people and businesses will be able to invest again in the future because they know there's a future that exists. So the good news is there's a great era ahead of us, a really wonderful one. I can't wait to it. There's some ugly times ahead of us. Most people predict that it's going to be the rest of this decade of unpleasantness and difficulties. But something should galvanize the society to leave the post-World War II order behind, one that's been around for 80 years, doesn't apply to us anymore. It might be awful. As Grant Williams writes, there will probably be more books written about the next 10 years and the past 10 years than any book since World War II. So it might be very ugly, but I believe we'll make it through as we have for hundreds of years in Anglo-American society, at least. We've gone through much worse than this. We've built, grown, moved forward. It'll be wonderful again and happy. Just buckle up for the next decade.
Got it. Thank you so much for being on the podcast, Emil. It was awesome having you.
You're going to be guiding us. We're going to be listening to the voice of a new generation. So you'll have to be helping us along. So thank you very much. I loved it. It was wonderful. This is much better than a show I do with Jeff.
No, not at all. I think,
if you need an intern, you let me know. I'm going to join your show.
Thank you. Thanks for being on.